Thanks. Well, shares of Kansas City Southern surging this morning. This after the company agreed to be acquired by Canadian Pacific Railway in a deal valued at about $25 billion. Now, if approved, it would create the first freight rail network linking Mexico, the U.S., and Canada. Joining us now for a first on CNBC interview, Canadian Pacific CEO Keith Creel. Keith, thanks for being with us this morning. Congrats on the deal.
Hey, good morning, Morgan. It's my honor to be with everyone this morning.
All right, so we've heard about the possibility of a Canadian railroad and a U.S. railroad coming together for years now. We haven't seen it happen until today. Why now? And perhaps even more importantly, how is this a vote on not only economic recovery in North America, but growth?
Well, I think maybe the why now is better said. That how can you not now? It's a perfect time for a deal like this. And often for a deal like this of this size, this magnitude, you know, the stars have to align, and I would suggest the stars have aligned to enable this deal to happen. You've got two railroads, actually two of the smallest railroads in the Class 1 space that have enjoyed and produced an outsized performance. We've led the industry the last 3 years and on a CAGR basis from growth as well as earnings growth. That's pretty compelling. So when you've got two like-minded CEOs, two like-minded companies focused on growth, focused on providing great service, that see the power of this combined network. You know, I've been in this business for 30 years. I've long recognized the value that could be unlocked combining these two networks. So to have that opportunity now to partner with Pat and his team at the KCS at this historic time, you've got USMCA as a background. North American trade has never been more important than it is today. So again, how can you not do this now to create an economic backbone, a network that can serve as the backbone to drive that growth for all the stakeholders? It's pro-competition, it's pro-service, it's pro for customers, employees, and the North American economy. So how can you not now?
I want to get into all those pros, but first, it's my understanding that yourself and the folks over at Kansas City Southern, Pat Ottensmeyer and the like, really began talks in earnest in December. How did this deal come together?
You know what? As I said, I've had my eye on the KCS for quite some time. I've been leading this growth story and serving with my team at Canadian Pacific for the last 4 years as the CEO. So strategically, it made a lot of sense. Given the backdrop of what happened last year with coronavirus, given the opportunity and seeing the growth opportunity coming out and the strategic shift of nearshoring, where we're bringing manufacturing back to North America, I couldn't help myself but to reach out to Pat. And I said, Pat, this just makes too much sense to bring these two strong companies together to create something we otherwise would never be able to create for our customers or for our shareholders apart.
Yeah.
And Pat saw that. And so those discussions began in earnest and became serious during the last quarter of last year and have developed to the point that we're able to share this exciting news that we did with the markets and with our customers yesterday.
Precision scheduled railroading. This is the term I think a lot of investors have become pretty familiar with now. You're a protege of the late Hunter Harrison. You've operated Canadian Pacific using that methodology for a number of years now. We've seen most of the other Class 1 railroads adopt PSR into their operations, including Kansas City Southern. How much more efficiency, when you combine these two networks, can you actually wring out of the system?
Well, listen, that's part of the beauty of precision scheduled railroading. I've said this in the past. It's a gift that keeps on giving because it's all about continual improvement. It's about executing an operating plan. It's about optimizing processes. And if you do that, you create a great service that's a low cost. The natural outcome is synergies on the cost saving side. But listen, this deal is not driven by synergies. That's the beauty of it. The power of this deal is actually about revenue synergies, growth synergies. The benefit, sort of the cherry on top is actually those cost synergies too. But again, the synergies we talked about, $780 million for our combined shareholders. 3/4 of that's growth synergies enabled by this network with new revenue markets, and about 1/4 of that is operational synergies. That's a natural outcome, again, of how we run our business. And I would suggest that both the growth synergies as well as the revenue or the cost synergies are underestimated. In fact, I'm firmly convicted in our ability to be able to not only meet those expectations, but to exceed those expectations.
Shepard Smith here. Thanks for watching CNBC on YouTube.